Home prices are up about 10%, but your monthly payment is up 60%. Same house, same neighborhood, completely different math. You did everything right. You built a six-figure income, kept your job stable, saved up a down payment. You should be ready to buy. And yet, when you sit down with the actual numbers, they don't work. Not even close. In the next few minutes, we are going to break down exactly why that is happening. Not the headlines, not the politics. The actual mechanics behind why your salary feels like it shrank the moment you started house hunting. By the end, you'll be able to backsolve your real budget and stop guessing. Here is the thing to remember going in. The price tag is not what got you. The financing math did. The first thing to understand is this. The listing price is not the payment. Most people look at a home price and try to figure out if they can afford it. But the price is just the starting line. What you actually pay every month depends on how much you borrow and at what interest rate. When rates move, your payment moves, even if the price stays exactly the same. Here is how that plays out in real numbers. In 2021, rates were roughly in the high 2% range. On a $600,000 home with 20% down, you are borrowing $480,000. At that rate, your principal and interest payment comes to about $1,954 per month. Now move to 2026. Rates are sitting around 6%. Same $600,000 home, same 20% down. That payment jumps to $2,881 per month. The house did not change. The rate did, and at a higher rate, more of every payment goes to interest instead of paying down the house. But home prices did not stay flat either. Add a 10% price increase, and now that same home is $660,000. At 6%, your payment climbs to roughly $3,169 per month. That is a 62% jump in your monthly payment for a 10% increase in price. That is the rate lever at work. Now run a quick income check. A $120,000 salary works out to about $10,000 per month before taxes. A common rule of thumb is to keep housing costs around 30% of gross income. That is $3,000 per month. Your principal and interest alone is already past that line, and we have not added taxes or insurance yet. So the rate is doing most of the damage, but there's a second problem sitting underneath it. Even if your salary went up over the last few years, your savings did not keep pace with everything else. Inflation quietly eroded your down payment buffer while home prices were moving in the opposite direction. Here's a simple way to see it. Say you saved $60,000 for a down payment. A 10% price increase on a $600,000 home means your 20% down payment target just moved $12,000 further away. The finish line keeps shifting while you are still running, and that's before closing costs, moving, furniture, life. The ratio between home prices and income has also changed in a fundamental way. A generation ago, homes often cost roughly 2 to 3 times the average household income. Today, that ratio is closer to 6 times income in many markets. Same work ethic, completely different math. This is why so many high earners feel like something is wrong with them. It is not your effort. It is the structure of the numbers. Here is the second misbelief worth correcting. A fixed-rate mortgage does not mean a fixed housing cost. Your principal and interest are locked in, yes, but your escrow is not. Property taxes get reassessed, insurance premiums go up, and in some markets, insurance costs can jump 30% in a single year, which can push your total payment over your budget without any change to your rate. Your mortgage can be fixed and your payment can still rise. Here is what the all-in payment actually looks like on that $660,000 home. Principal and interest, $3,169. Taxes, $600. Insurance, $350. HOA, $250. That is $4,300. You thought you were buying at $3,169? You are actually buying at $4,300. And if you cannot put 20% down, private mortgage insurance adds another line item on top, a fee that does not build any equity in your home. So, what do you actually do with this? The first step is to stop comparing your timeline to your parents'. The mechanics have changed. That is not a personal failure. It is just a different set of inputs. Start by working backward from a payment, not a price. Pick a monthly ceiling you can actually sustain, say $2,800 all in, and then calculate what home price that supports at today's rate, with realistic taxes and insurance included. If that number doesn't buy what you want in your zip code, that's not failure. That's data. That reframes the search and removes the shame spiral. From there, use what I call the price, place, timing triangle. You have three variables: the price of the home, the market you buy in, and your timeline. You cannot keep all three exactly where you want them. Pick two. The third one is the sacrifice. Same metro means a smaller home or a different neighborhood. Same home type means a different, more affordable city. Same everything means a longer timeline with a bigger down payment or waiting for a better rate window. On the financing side, treat it like a mechanic, not a gambler. Shop multiple lenders. Small rate differences compound fast at these loan sizes. Look into assumable mortgages where available. Build your down payment strategy around hitting a payment target, not just a purchase price. Tonight, take 30 minutes and do three things. First, find the rate you would actually qualify for. Call a lender. Get two pre-qual quotes online, or use a mortgage calculator that lets you enter rate plus taxes and insurance. Second, estimate property taxes and insurance for your target zip code. Third, set an all-in monthly cap and backsolve your maximum home price from there. You are not behind. The system shifted. Now you adjust the inputs. The math changed. Your value did not. Run your own backsolve this week. Set a payment ceiling, work backward to a home price, and let that number guide your search instead of the listing price. If you found this useful, hit like, subscribe, and turn on notifications for more simple explanations.